The commercial real estate sector is on the verge of collapse, with loans being forced to refinance at high interest rates and plummeting demand. And as overexposed regional banks teeter on the brink of crisis, studies show large banks are also at risk as the prospect of a full-blown banking meltdown emerges, and Americans are seeking shelter into physical gold and silver as a way to protect their funds before potential chaos ensues. Now, regional banks have been at increasing risk, with the commercial real estate market taking a beating from the Fed's aggressive rate hike campaign, and commercial real estate loans are being repriced at higher and higher rates, and their tenancy is falling. Banks are stuck holding mortgages and construction loans that are underwater compared to plunging property values. And now the risk appears to be spreading to the larger banks as well. Large banks, of course, have direct loans, but their biggest exposure often comes in the form of real estate investment trusts, or REITs. Now, a REIT is a firm that buys and operates commercial real estate, selling shares to investors who want to gain exposure to the space. These vehicles are often very debt dependent and very vulnerable to high interest rates, which are depressing revenue. Investors are squirming and pulling investment money out, and with the rise of redemption requests, the REITs have tapped banks for more credit. In fact, this line of credit extension is increasing faster than any other form of borrowing. A Florida Atlantic University study found that 67 of the largest U.S. banks have CRE loans exceeding 300% of their total equity capital, which regulators consider to be excessively risky. Furthermore, the FDIC increased the number of banks on its problem bank list from 52 to 63. Now, the number of banks on that watch list is actually 60% greater than the quarter preceding the collapses of the First Republic and Signature banks last year. More than $517 billion in losses are now being held by banks. Morgan Stanley also warned that commercial real estate prices could crash 40% in a disaster that would be worse than the financial crisis of 2008. More than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months, when new lending rates are likely to be up 350 to 400 basis points, and borrowing costs and tighter credit conditions could raise difficult hurdles for big real estate investors as they seek to refinance a mountain of loans. And Morgan Stanley also feels this damage won't stay contained to the property owners and the banks. It'll extend to interconnected business communities, private capital funders, and owners of any underlying securitized debt. And the tech and discretionary sectors won't be immune to this. Now, in a scenario that's eerily similar to the 2008 Great Financial Crisis, where retirement savers lost up to 50 to 60% of their funds, Americans are looking for protection. If you're concerned about where the economy seems to be headed, you're looking for a hedge in your portfolio, physical precious metals is a great way to take some risk off the table. I'm Makai Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical gold and silver into your portfolio or to your retirement account can give you the protection that you're looking for.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.